One of the key aspects of, again, this wonderful human civilization is to be able to estimate cause and effect, and based on that to be able to predict. Estimating cause and effect is absolutely the primary reason why we have developed as a race in all of these years, because if you're not able to do that, we would not be able to repeat, improve, and move into continually into newer directions. Unfortunately, as I said, humans are the only species who are able to do forecast, extrapolate, and so on. Unfortunately, to do this in a man-made system, in an artificial system, in a non-natural system like money or social field or economic field is going to be a complete disaster. I'll just give you some examples of the ludicrous predictions people have made at different points of time in history, some specific, some generic, some really funny ones. First, every December, Business Week magazine surveys Wall Street strategies for the next year's target of the market. On an average, this has been off by 26%. Specific case, 13th August 1982, Wall Street Journal and New York Times quoted many analysts and traders who said, well, we need a selling climax to end this bear market. That very day this article appeared, the greatest bull market began, lasting 18 years. On the other side, at the peak of the market on April 14, 2000, Nasdaq closed at 3,321. And two persons, one, a fund manager of Kemper Fund, said this is one of the greatest opportunities for investors in a long time, and somebody else said there's only 200 to 300 points of downside and maybe 2,000 points of the upside. Exactly the opposite happened. It turned out that there were no points on the upside and more than 2,200 on the downside. I have been watching analysts, fund managers forecasts. Sometimes I do watch television for fun. So I used to watch around in 2001, 2, and all of these Diwali forecasts where people would come and talk about it. And I have never ever found, until and unless something is a lucky kind of a streak, which is 2004, 5, 6, and you don't know why the market is going up, you know it's going up, and therefore you predict, you extrapolate. Most of the time, all of these experts who come on television and forecast the prices are utterly wrong. And one of the most notable persons who's been wrong belongs to one of the greatest financial institutions in the world, which is Goldman Sachs, a lady called Abby Joseph Cohen. She's been wrong for the last 10 years, and now finally she's retired. A lot of people think that if you are inside, you're in a position of power, you are able to see a lot of things. Like, let's say, the finance minister. If he says something, obviously he's very knowledgeable, he knows a lot of things. Or a finance secretary, obviously he knows. One of the finest examples of this not being true and being utterly wrong is this one. In January 1980, with gold at a record price of $850 an ounce, the US Treasury Secretary declared, it doesn't seem an appropriate time for us to sell our gold. And the next day, the price fell 17%. Over the next 21 years, the price fell 70%. He said it exactly on the day before, the 17% crash, which was the beginning of a total 70% crash, right? David Dreman has done a very interesting study. He's a value investor and he has got 3-4 books which are worth reading. And he has collected a complete database of what analysts have forecasted. And he thinks that their forecasts are wrong by 41%. Imagine, somebody says it will be 100, it's turned out to be 59. I mean, it's just incredible kind of a margin of error. This is, as he said, it would be saying that it will be 30 degrees outside and it's turned out to be only 18 degrees. It will be quite chilly and cold compared to being warm. In all of these situations, the modern life doesn't help because we are exposed to this range of experts and their wrong predictions continually by none other than media, of which we are a part. I'll come to that in a little later. There is an organization called CXO Advisory Group, and this is a website that you must write down and probably go and check for fun. It is a live, continual database of all those gurus who make market prediction. Thanks to internet, all of these things are possible, which was not possible earlier. Now somebody takes the trouble, okay, these are the 40, 50 gurus. I don't remember how many of them are there now. But these are the gurus. Let's see what they say and let's put it down. And they found that the average accuracy is 47 degrees, exactly what that guy in the cartoon is doing, which is tossing a coin. If you toss a coin, you will get a 50% accuracy over a long period of time. This is even less than that. It's 47% accuracy. There is a gentleman called Philip Tetlock. He's really the ultimate resource person for analyzing and creating a database and tracking forecasts. He's a forecast guru. Okay. He tracked 200, this is on the political field, he tracked 284 political experts over 10 years. And they made 82,000 predictions. He's got a website and he's got a couple of books whom you may want to read his books. The forecast, completely random, less than 50% all over again. Now here is the kicker, this is the most interesting part. The best predictor, the more sought after by the media, the worse is the pundit's accuracy. These are his words, these are not my words. And this is based on database of experts that he has tracked, right? I'll take you through some funny ones. Let's not draw too much of conclusions in this, but just for the sake of fun. Forecast in 1894, horse-drawn carriages would be so popular and everybody would want to use them that entire London would be under 9 feet of horse shed by 1944. Didn't happen, right? Why it didn't happen gives a clue of what happens in a real life situation, in a man-made situation. What happened was something else, which this person who was looking only at horse-drawn carriages and extrapolating in a simple linear fashion, so many carts, carriages, so many people. By 1944, so many people would be needing so many carriages, multiply. Oh my God, look at this. In this simple extrapolation, this is how forecast failed. He would not have reckoned something else happening somewhere, by which horse-drawn carriages would not be needed anymore, which is internal combustion engine. The moment that comes in, this entire calculation of horse-driven carriages goes out of the window. And this is really the peril of forecasting. When you are forecasting, you are depending on an available set of data. That's all you know. It's like a frame. So you're looking into the window and your forecast is a frame. Outside the frame, there could be 20 different things you're not even aware of that. The frame shifts, your forecast goes for a toss. Some funny ones. 1876, an internal memo of Western Union. This telephone has too many shortcomings to be seriously considered as a means of communication. Right? Western Union. Second one, 1895. Lord Kelvin, who is the president of Royal Society, he said flying machines heavier than air are impossible. 1927. Warner Brothers. Who the hell wants to hear actors talk? Yeah? It's incredible. Thomas Watson, IBM. I think there's a world market for maybe 5 computers. Okay, he's head of IBM. 1962, we don't like the sound. Guitar music anyway out. About Beatles, which is a amazing phenomenon just after 1964. And finally, Bill Gates. 640 kilobytes of memory ought to be enough for everybody. It's so incredible, right? And these are experts in the field. There is nothing shameful about these predictions. We can laugh at them, but the fundamental thing is that they all made the predictions based on what was available at that point in time, without thinking that this whole paradigm, the whole frame can change. 20 new factors can come in. This is why I keep repeating, in the market, it's complex, emerging, and adaptive. It's complex, the complexity changes, it's emerging. So a new 5 different things will come, so your original frame has got no relevance. And it's adaptive, the market itself adapts to what we do with it. Fourth thing that we are constantly have to deal with. Nothing other than one of these finest examples of the surprise and how people react to surprise and what happens subsequently. On September 28, 2000, Apple Computers announced a 27% higher profit. How did the market react to it? The stock fell by 52%. It's just so incredible, isn't it? A company announces 27% higher profit and it fell by 52%. For every $1 million shortfall in expectation, the market cap went down by 90 million. It's so amazing. Now, something that has suddenly become so cheap, like apples, from 140 rupees it becomes 70 rupees, you would buy more or you feel like buying more, right? Were the analysts going and re-rating it now that the price has fallen? No. They were downgrading it further. They said that the outlook is absolutely cloudy. The stock fell even further. So it fell to almost $7. I think it's $7 or so, not $6 or so. But the real surprise came later. What happened after the stock fell by 50% and then another by 50%? Just to give you two charts, that was a time the analyst downgraded, and you see that huge bar over there, that is a 50% fall and then a further fall, right? Can you even see that in that screen anywhere? That huge decline, because the stock from that point of time is up 110 times in 11 years, from 2001, roughly 2001, right up to 2012. What happens in situations like these? Why do we react in this kind of surprise and we are not able to correct ourselves? Again, let's go back and see what our ancestors had to do, as this gentleman, the neuroscientist Arnie has said. What our ancestors had to do is react quickly. First of all, they had to detect patterns. They have to find those patterns. They had to apply those patterns. If the patterns didn't match, they had to react with absolute utter speed and panic, because there was just no other option. In fact, when they started migrating from their earlier habitat in East Africa, and which is Kenya and Ethiopia and all of these areas, and started migrating, the climatic conditions changed. The habitat changed, the kind of animals they dealt with actually changed, so the surprise level was much, much more. Even they had to react even more faster. Then there were situations like mushroom, which is one of the best examples. Two kinds of mushrooms may look identical. One is edible, one is absolutely poisonous, right? So even patterns failed. So they look the same. Oh, mushroom, I ate it, it's nice. You eat it, you fall, you drop dead, okay? To survive, they had to react with the greatest, surprise to the least amount of differences. So moment, known pattern, out. This is why, this is how they've survived actually. Now to go into a little bit of explanation, this happens in a certain part of our brain called ACC, alright, which is called anterior cingulated cortex. Now ACC has got multiple functions to do. It detects errors. If I knew something is not matching, it's an error, okay, and then helps generating a surprise. Interestingly, biologists and behavioral scientists have found that humans have at least twice as many of these cells which generate the surprise as apes do, and in fact the other animals don't even have that level of, they probably have 1/10 of that. So we actually were destined to become a superior race because we reacted with great deal of surprise and took corrective steps, okay. The speed is so fast that it could be 3/10 of a second, because when you process matching, not matching, 3/10 of a second, and you have to take corrective steps, okay. Interestingly, ACC is also connected to another part of the brain which regulates pulse, blood pressure, temperature, etc. So when a surprise jolts us, it can hit that part of the brain which is hypothalamus. That's why a small change can create such multi-billion-dollar panics. Very often people ask, but what happened? Nothing is wrong with the economy. Nothing happened to suddenly any of these companies yesterday. So how is it that sometime in May 2004, when BJP seemed to lose power, the market hit lower circuit intraday, and suddenly, unexpectedly, sometime in May 2009, when UPA had to come to power, the market hit upper circuit. Just see the mirror differences. This is the time when India lost. This is the time when UPA came back to power. If you ask rationally somebody, what really happened in a matter of 2 days to the economy, to the companies themselves, the fact that Bajpayee was Prime Minister in one day and he was not the Prime Minister the next day, or a coalition went out and another coalition came back, probably it was the same coalition, what happened to it? Nobody will be able to offer a rational expectation. It's nothing other than the fact that you wanted a certain pattern, it didn't match exactly like it happened, and here it's much more magnified because millions of mine move in a herd instinct. He sells, so I have to sell. I don't want to be any different. This is exactly the pattern that people have used to survive. If somebody is running away, looking at black and yellow stripes, you also have to run. You can ask him later, what did you see that you're running? You're not going to look around and apply your mind, right? So same herd instinct, same formula that has helped us survive and developed and grow is also in action here. Just to give you a little perspective on where we stand on money matters, on the things that we have created, whether it's a credit card, whether it's a stock market, whether it's a banking system, what is it, where does it stand on the time scale of human evolution? Homo sapiens have been evolving for 2 lakh years, all right? We are proud of this incredible technological progress, but the fact is domesticated food crops that we are using, which is barley, millet, wheat, etc., date back to only 10,000 years. Earliest known of markets was somewhere in Mesopotamia, which is modern day Iraq, where people used to trade based on tablets. They used to write down something in a stone, exchange, that was a medium of exchange, and he'll give you 6 bushels of wheat, you take back the stone, and so on and so forth. That was the earliest known markets. And markets, modern markets of stocks and bonds, just 400 years. So if you create a timeline of 1 mile long scroll, your stock market is going to be just 4 inches from the end of 1 mile long. The world, this is our evolution, and that's where the stock market is. So we have to bring all of these things of our evolution to actually deal with that, and we often fail to do that. It's just because it's just too short a time for us to have evolved in understanding money. This leads to a large number of biases. This is to give you some examples of the kind of biases. Sunk cost bias. One of the most common things you will hear people say, I bought this stock at 170, it's 90 now, I'm holding on, when it comes to 170 I will sell. And very often, quite sadly, if it's a good stock, it will go past, it shoot past 170 and go on to probably become 500, and you will regret. This is a familiar story, all of us go through. There's nothing shameful about it. I don't mean to laugh at any individual. It happens to everybody. It happens to me also. This is called sunk cost bias. You get anchored to it. Confirmation bias. I have repeated, those who have attended my sessions would know that I have repeated this many times, because when I first got to know it was a really big surprise for me. And one of the finest examples of this is George Soros. If he has an investment in something, he never asks whether he's done the right thing or not, which is what we would ask. I have some shares in Reliance. You think I've done the right thing? Which is a confirmation that I'm seeking. Somebody says, yeah, it's a big company, blue chip company, a lot of cash flow. I'm very happy. George Soros just the opposite, because he knows all of these things, the evolutionary problems. He only wants to know where he can go wrong. So if you are a serious investor, you should ask that rather than asking what can go right with your investment. Where can I go wrong? That's what he wants to know. Anchoring bias, very effectively used by a lot of salesmen. They want to sell you a house, they'll show you something more expensive, better. No, this is not what I want. Show you the next one. Your mind is stuck over there. This is cheaper than that. You've anchored to it, right? Very often, even in shop floor, this happens. All our troubles are caused by a couple of things more. And one of the things that is the biggest culprit, in everywhere I see the presence of what is called recency bias. Anything that has happened recently is there uppermost in our mind. If for 2 years or 3 years in a row the market has gone up, that is uppermost in our mind. If for 5 years mutual funds have not given any returns, all the newspapers will write mutual funds have not delivered, they are not giving any returns, they are useless for investment. Buy fixed deposits, at least your principal is safe, you are getting a fixed income. Anything that is recent is always uppermost in our mind, and wherever you see any kind of a problem, if nothing else, you can track it down either to over-optimism or belief in that recent events will continue to happen in future. Hindsight bias. There are some studies here which I haven't quoted, but one of the most celebrated hindsight bias studies was done on some Israeli students. This is a little old, but doesn't matter how old it is, it will be valid forever. This is a survey done by Amos Tversky, who is a partner of Daniel Kahneman, and he had interviewed some Israeli students of psychology. They are trained, all right? So they are studying all of these concepts all the time. This is in 1972 when President Nixon was visiting China. And the survey started before this trip was announced. So they were asked, do you think he'll go? Do you think they'll sign anything? Do you think there'll be peace? Almost 90% said no. And about 6-8 months after the event, this was all planned. They went and took hold of the same students, and 87% said, hey, I said so. This is called hindsight bias. So you think you have said it was right. Everybody knew Google, you should have bought Google when it went IPO. Everybody knew it would go up. This is called classic hindsight bias. I'll just summarize 4 of these. We look for patterns, 2 consecutive things in a row, we naturally expect a third in the same direction. Recent events I've already mentioned. Relative numbers hugely plays in our mind. A 52% decline of Apple computers would have sent panic among everybody. All the most die-hard Apple users would have said, my God, I think let's sell first, as our ancestors would do. First sell, then think later. And that is all because of relative numbers. 16-17% fall in a given day. In a whole scheme of things, if the same thing happens again, we will not think that the index was some 2000 20 years ago and it's some 17,000 today. That time, that number is really dominating our mind. Exactly the opposite. If something has gone up by 120%, my God, 120%, irrespective of anything, that is the one that dominates our mind, independent of anything. I had mentioned earlier that even if you try to get rid of many of these biases, you should be able to do. But what makes your job really, really hard is what comes from media. That's one of the most difficult things to avoid. You can't be sitting in a room and doing all of these thinking all by yourself. The moment you step out, you are assaulted by all of the mistakes that others are making. You want to step out of the mistakes, but there are others to pull you down. I'll give you some examples how media makes it works. When they talk about, Economic Times had a long article which said that, stocks, Sensex 30 stocks doesn't even beat FD, what is the point, and so on, right? A lot of people say stock markets extremely risky and extremely volatile. Even from the peak of 2000, the market is, by the way, up 350%. And this is a little old data, maybe up by 370% now. We tend to forget that huge events, the first one, World War I, second one, World War II, this one, Indira Gandhi's assassination, Rajiv's own assassination, Babri Masjid. We've lived through all of these things, right? When a next similar event happens, that's Taj, and finally it's the Japanese tsunami. I've just taken at random some things from the last 70, 80 years. If anybody says that we are really living through difficult times, believe me, all the time I think, and because I've read a few books which were quite disturbing and quite, one couldn't sleep for days together, which is what the torture people went through in the Nazi concentration camps. And I'm quite alive to the fact that what people went through in the world wars. My parents came from, what was East Pakistan, so they had completely fractured life that leave everything and come here. I cannot imagine our lives, anywhere near that, what it was, okay? And the world has moved on and the world has improved. We don't think of that. When it comes, the most recent events and the bad events dominate our mind. We say, oh my God, this is so bad. This is really terrible. Things are getting from bad to worse. And when the next event happens, we'll react exactly in the same way without thinking of all of these things. Worrying economic issues. You read the papers, industrial production is down, the inflation is up, euro is going to crash and burn. Till last year it was dollar, now it's suddenly euro. Now we'll very soon, don't worry, we'll go back and say the dollar is over, now gold will be the currency and so on and so forth, right? Economic issues are terrible. They are nothing compared to what world has gone through, and all of these things that we are seeing already has happened. Each one of these events has happened in the past. High commodity prices, high debt deficit, inflation, recession, credit crisis happened many times before, and all of these things are there in this wonderful book written by Ken Fisher. And the name of the book is, I don't get it, it won't be the exact same words, but roughly the name of the book is People Forget But Markets Don't. Okay? And so the markets will do what it has to do, and it will take into account all of these factors and do, but people will not. Every generation, including the fact that PIMCO has come up with a word called new normal, which you will see in the papers every day. The new normal is really no growth kind of a scenario. You would be surprised to know that the word new normal existed in 1984. So it's astounding, and it's there in that Ken Fisher's book. 74, the oil shock. We are now used to $100. Today is 97. Again in 2008. Latin American crisis, 1994. In 80s it happened. I missed that. 80s, Citibank literally was wiped out with the kind of money they lent to Latin America. 94, same thing. Mexican peso. I remember the world was in a panic because Mexican peso went on a free fall, and there was Brady loans and so on and so forth. 97, Asian crisis. Again, one of the hottest growth areas in the world, which is Thailand, Malaysia, Korea and so on. Completely, people said that it's over. They're never going to come back. Korea has come back to become a first world country holding Olympics. All right? 1998, Russian crisis. Where was Russia has actually defaulted in 1998. It's a very thriving economy today. Not the best of places, but thriving economy. 2002, people have forgotten all about it. Accounting scams. Biggest of companies, Arthur Andersen, Enron, Broadcom, all kinds of companies, JDS, Uniface, WorldCom, as I said, huge number of accounting scams, changes in law and everything. You will bet that in 10-15 years again people are going to talk at some time about accounting scams, new kind of accounting scams. 2008 subprime crisis, now of course dollar and euro crisis. All of these things come and go. These are part of life. This is part of civilization. It has all happened, and worse has happened before. Unfortunately, faced with all of these things, the media does not play a restrained role because they have a business to run. And their business, the latest, newest, biggest ever, worst ever, every time it's all superlative, sensational stuff. So even if you want to move away from all the biases that you've been handed down by your ancestors in their effort to survive, there is this media to put you back into all of these biases with recency, optimism, overconfidence. All of these things are put back in your mind the moment you open a newspaper or you watch television. There's just so many channels to watch. Unfortunately, this is something that we know because we are inside. News is done by people with just a few years of experience. A lot of stuff on the internet is free. We read, we pass it on. It's so easy to do, and so much of rubbish is also gets passed on because everything is fairly free and easy to forward. We notice and we write about it repeatedly. The media is repeatedly wrong for exactly the same reason. They are, after all, the same set of human beings. They are like you and me. They are reacting. They are overreacting. They are, even if they don't want to do something wrong, purposefully, still they can't help it because they are humans after all. Go back to Philip Tetlock. So it's such a brilliant study. And he commented that the media's preferred pundits are forceful, confident, and decisive, not tentative and balanced. Bold, decisive assertions make sound bites. Bombast, however, certainly make for better TV. You won't find people who are tentative over there. Two of the finest examples of their forecasts and how they lead you to the wrong way. This is a forecast of Fortune in 2000. 10 stocks to last the decade. A few major trends will likely shape the next 10 years. Here is a buy and forget portfolio. How astounding. You just have to buy and forget them. Of the 10, only one increased in value. 2 went bankrupt. You can see they're 100% loss. The red ones are all the losses. And the rest saw terrible returns. Overall, a 44% loss. This is by Fortune of the US. Right? It's quite astounding to even think that you can make this kind of prediction and put it out in the public domain. So we say most of this is pure noise, tons of opinion every day, constantly influencing our actions without us being aware. We look at it, we read it, and we do something. As I said, all of the right brain activity is happening rapidly, automatically, unconsciously. And that's the unfortunate part. My last slide, what we should be doing, obviously, as you know, my point of view after having listened to all this, the average saver should tune out most of the media noise. The vast majority of it is not meaningful, and if you have to actually pay physically, separate, equal and continuous attention to everything that you see, any piece of information, you will simply break down physically. So your mind retrenches, it looks at things selectively, which is making it worse. Because you will look at it, what you think is important, whether it's rational or correct or not is not relevant. So once you listen to all of these things, I do hope you train your mind to deal with all of these biases. Read and remember, one of the difficult things to do, but there is no option. When you read something interesting, just read and write it down and try and compare what happened in the past. Most of the time you think it wouldn't be worth it, or it would be relevant, or it would turn out to be wrong from what the expert or the popular media is saying. And the reason for all of this is that we are in a man-made world, and the patterns and conclusions that we are drawing in a man-made world are completely different, complex, random, very difficult to get your arms around as compared to what happens in the natural world. Thank you very much for listening.